In this session, we will understand what an audit pack is and how the entirety of it works. So, audit pack is basically an Excel spreadsheet which is very comprehensive, which includes financial statements, the balance sheet reconciliations, corporate tax computation, cost plus ROS computation, gap recon, that is nothing but US GAAP to local GAAP or statutory reconciliations from the P&L perspective, and the statutory trial balance. So what is StatDB? So as Juniper Inc. is a US based entity which has to report as per US GAAP. So the entire of the information that we download from SAP is US GAAP driven. So obviously we cannot report that numbers without making adjustments or truing up or truing down our accounts to reflect in country specific gap requirements. So what lands happening is we have got a US gap trial balance which is coming out of the SAP, that is our ERP system. Then we have to make certain adjustments to take into account or to modify US gap so that we report in country specific gap compliant accounts. This in country specific gap accounts can be IFRS, Ind AS, or anything which has been accepted by the authorities. So US GAAP comes directly out from the SAP. Now let's focus on how the statutory entries are made or what are they made up of. So statutory entries can be broken broadly into two types. One is permanent and one is timing. When we say permanent, we mean long-term timing entry because they do not reverse or do not get adjusted in the very next year, or it takes a substantial long period, like low value assets. So what happens in the US set of books or for US GAAP accounting is they have got a threshold. The threshold is if the value of a particular asset is less than $500, they will not capitalize it. So it sits into the expenses. So there are like three accounts which needs to be analyzed at the end of the year. In these three accounts, usually there are expensed equipment, that is low value assets. And we do our analysis looking into this and we move it out of the expenditure and we push it to the balance sheet as form of fixed assets. So because of this, our fixed asset register also will have to be tuned up to the low value assets. So this forms a part of first difference. Then deferred tax. Deferred tax is not created at entity level basis in country specific tax laws. So there is one single deferred tax which gets created in US books as per US tax laws, and it is not pushed down to the subsidiary entities, rightfully so, considering that there is a lot of difference between the two tax policies or the tax acts. So we create this permanent entry which keeps getting carried forwarded. Share-based payment also follows a similar line. Share-based payment is accounted only in US entity until or unless there is a specific requirement that there has to be a push-down accounting, like India. Apart from these, we do not do push-down accounting in US GAAP set of books. So there is, if in country-specific requirement like IFRS 2, which is share-based payment accounting is required, then the same is calculated and we post this entry only for the purposes of being GAAP compliant. Now coming to lease accounting, US GAAP and IFRS has some differences and basis our own computation methodology, we see how much should be the right of use asset and lease liability, so on and so forth, and we see what entries needs to be posted. Now, because of all the above entries and all the timing entries that we will be discussing shortly, the cost plus adjustment also changes. The reason being, if I push in more expenses or I remove more expenses from the P&L, then my cost base changes. And as the entities are cost plus entities, that is the way the master service agreement works is there is a certain OPEX on which my revenue has to be marked at a certain percentage. And as the cost base keeps moving, we'll have to also make sure that our revenue is in line with the markup percentage, and intercompany cost plus adjustment or an ROS adjustment is posted. ROS is a return on sale, and this is applicable for a entity which is a trading entity. Now coming to timing entries. There can be certain entries which can be posted after the year end, like MBO, commission, or PTO, which has to be trued up or trued down basis the actuals. So since we have got time after the books have closed to peek into, let's say, January, February, March window or in the accounts and see what has actually been the commission payment or what has been the bonus payment. And basis that we can look into those accounts and make sure that as on December or as on reporting date, we are reporting the right numbers or we are truing it up or truing it down to show a realistic number which would have had taken place. Prepayments. So again, US GAAP has a policy that if a threshold is not met, it is expensed off, and there is no concept of prepaid if it is below the threshold category. But in subsidiaries, what happens is it lands up becoming a material amount. So what is done is the expenses moved out and amortized over the period of the term of the agreement. Now, next is bank reconciliation items. There are times when certain entries could not have been posted, or the refund that was received, or the payments that were to be made were initiated but not paid, or refunds were not accounted at the right place. So, for that, we'll have to take a timing entry. And then this obviously all this entries that we are discussing will form a part of US GAAP set of books or US GAAP accounting in January, February, or March. Or if it doesn't, then we will have to initiate or we'll have to have a conversation with the general ledger accounting team and suggest the right course of actions. Accounts receivable and accounts payable as per 13th month testing. So what happens is we do test for accruals to make sure that our books are rightfully stated or the closing balance, what we are reporting, is true and fair. So we do peek into the January, February, March, or to whatever time we have, and we start looking into it whether there are invoices which we have received which pertains to the period of the audit that we are dealing in, and if so we post an accrual entry for that. And with respect to accounts receivable, what happens is if subsequently a credit memo was raised for a invoice which was done, and it can have several reasons to it why a credit memo was raised, so that credit memo gets accounted. And FX related items, if there are any entries which are denominated in foreign currency and those are monetary in nature, then we will have to revalue them as per the accounting standards, because if any of the above entries that we spoke about has underlying foreign currency and it is a monetary account, we'll have to post FX on it. And any other adjustments that we might come across during our course of review or analysis of our accounts. So without further ado, let's get into the audit pack and let's see what all do we have. So just to see the tabs, we have got certain tabs which is Juniper specific, and then whatever we see the cover sheet, balance sheet, P&L in English, these are driven as per in-country specific laws. Just like in India, we have got Companies Act Schedule 3, which says how your balance sheet should look like, and on that basis, this is prepared. And then what you see in light blue color is all Juniper specific that we prepare. So we'll get into this, and we're just looking at what tabs we have just so that we are a bit comfortable. This is the US GAAP trial balance, and then you've got all the reconciliations which give validity to the balance sheet closing numbers. So you can see that there is R stands for reconciliation, and then you've got all the tabs. So coming to the first sheet, we'll start with input sheet. So basically this goes on to tell us what is the name of the entity, what is the entity code, which year are we looking at, what are the tax rates, and what is our equity as per last year's signed financial statements. This is just to understand what the entity or what we are trying to look into this entity. Then there is checks column. Checks is basically in financial statements, there will be lot of numbers which has to be linked here and there just to see if balance sheet assets and liability is it going zero, is the cash flow statement matching, is the P&L number that we are reporting is as per trial balance, or are the notes to accounts and the numbers that is reported in the balance sheet or the P&L statements matching, and so on and so forth. Specific checks are put in place to make sure that there is no disclosure that we are giving incorrectly. For example, in balance sheet we disclose cash and bank balance 100, whereas by the time we go to the notes, it becomes 80. So just to avoid all that kind of issues, we have got these checks in place, and then we have got a checklist. Checklist basically is a series of activities that we do to make sure that the pack has been prepared in a sense that that we can justify that things were true and fair. So there are like 18 process checklists that we do, and once the controller has gone through all of that and prepared that, we just put yes, and reviewer at the time of review puts the or updates the column D. So you can pause at this particular point in the video and see what are the steps. We will get more familiar with this as and when we start preparing the pack. So I'll just move on to the next. Yep. So gap recon. So gap reconciliation is basically two folds. One is what was the US gap reported number, and then what is the number that is getting reported in the local books. So that is 5 million was reported, and then we said 2 million of adjustments for certain reasons, which we have justified over here. And we are saying 7.2 million is what the number is being reported in our financial statements. And then from there we say, okay, if 7.2 million is the profit before tax, then what were the items or what were the allowances and disallowances that happened due to the Tax Act law or the in-country specific requirements of allowances and disallowances, and what was the taxable income. We came from 7.2 to 7.1, and then we said, okay, on that there is a 34% tax rate, so we come to 2.4 million, and this is the current year tax charge. So this gives us a whole idea of, okay, how did 5 million become 7, and on 7 how did it become 7.1, that is the taxable income, and on that how much was the tax percentage. So this basically gives us an overview into the entire operations of the entity. I'll just skip these tabs because these are in country specific formats that have been provided to us, or we have seen it over the years. So let's get into the stat TB. So when you get into the stat TV, you'll see that there's a lot of columns. So we'll just see what are the columns. You can see these are US GAAP. This comes directly from the ERP system. And then this, we'll just discuss this shortly. We'll just see apart from that what columns here. We have got something called per recon. So basically any reconciliation that has been attached to justify a closing number of the balance sheet. You can see all this, and these are some contra differences because both are intercompany accounts. So we make sure that every number that is there on the balance sheet has a balance sheet reconciliation, and those reconciliations are well maintained and there is no cause for difference or concerns. And then we have got certain things which is like gap memo, how the numbers have to get pulled from NFS classification. From here the number will go into our balance sheet or the P&L. Yep, and to understand this, sometimes it becomes very complex. So what we have done is there is a simple calculation saying, okay, my opening was this and current year movement is this. So if I add these two, it comes to 8.7 million, which is nothing but my number, which is here. Okay, so what else is there in the sheet? Okay, the stat TB. We will take this up in day 30 of our onboarding kit, because taking this currently will just land up confusing more. So it's a very easy process. It's just do that. We don't want to overburden with information. So we'll get started with how this number comes. This is a straightforward number that comes from our SAP. As you can see, if I just open this link, it comes from our SAP, and you can see all the checks are going zero over here. These checks are basically to ensure that this particular account codes are getting reflected in our stat TB. And as you might have figured out by now that stat TB is the heart and soul of the entire audit pack, because this is the place from where every number gets linked, either in the tax computation, either in the gap memo, or in the financial statements. So a lot of care has to be given while preparing this. Now we have got all these columns. So like we were discussing that there are different kinds of entry. One is permanent, one is timing. There can be reclass entries also. Reclasses, if I want to present my numbers more accurately for the purposes of FS classification, we'll prepare it. One check we'll have to make sure is uh, reclasses has to be always done within the same set of accounts which are in the same FS classification. So you can see that this numbers is always going to zero if it is here. So this is P&L to P&L reclass, and you can see for the balance sheet also it's the same way. So balance sheet to balance sheet. So the way this is maintained is first we have got our revenue accounts, then we have got all our operating expenditure, which is called the OPEX, and then we have got other things like non-OPEX, which is interest income, other income, and then bank fees and unrealized effects, and then we have got our tax account, and then we have got our assets, and then we have got our liabilities, and lastly we have got our equity. Okay, so let's first get into the current year entries, and with current year entries, I think we'll be able to understand why this previous year entries are also forming a part of our stat TB. So let's look at one example here. Uh, let's take the M column, that is the 2021 temporary adjustment. So if I just go into it, I can see that there are certain entries. So like we discussed, prepaid insurance, it was coded to the P&L in the US GAAP. We have moved it out. So that's the entry. So what happens is, let's take one example and let's run end to end. So in the current year, I will debit my prepaid, which is balance sheet, and I'll credit my P&L. But how do I carry it forward? Because when I'm carrying it forward, I'll use an equity account, and I will debit my prepaid. So what happens at the end of the day is my entry when I have roll forwarded the entire trial balance, because I cannot carry anything in P&L, it has to go to retained earnings. So this goes into retained earnings in the opening balance of 2022. And then this prepaid was not more than 6 months, so we reverse it because, or we amortize it in 2022. So that time what happens is we debit the P&L in 2022, and then we credit the prepaid. So at the end of 2022, because of this transaction, the prepaid in the last year 2021 would be 188K, and 188K would have been moved out of the P&L. But whereas in 2022, we would have pushed 188K into the P&L, which US GAAP had already taken in the previous year, and our prepaid would go zero. So from balance sheet perspective, if you look, there would be no difference. Only if we take this particular case. If that's not the case, and this has more than, let's say, 24, 30, 40 months, then what we'll have to do is we'll have to move this into permanent entry and then start amortizing the 12 months balances proportionately. So that's that. So now we'll understand that every entry comes with an adjustment number. We are saying this is 21. Who posted it? It was us. So is it gap related? We say no. Then we have to say SAP account, and none of them were intercompany accounts. So we didn't touch any of the intercompany entries, at least not in the temporary entries. And then this is just a VLOOKUP of what this account stands for. This amounts are coming from the calculations that we have done. So at all point of time, if you go to, let's say this entity was 4,000. If I go to 2021, I go to my FS and I go to my supportings and entries, you can always see how the entries were coming So this is also a part of our documentation that if we post any entries, we need to make sure that there is a proper backend working for it so that if anybody asks us, we can always pull that Excel up and say, okay, this is how the computation was done. So I think we have covered it here fairly. And then let's move back to the stat TV. Yeah, and now let's go to the permanent entries. Like we were saying that there are certain gap related things. In Brazil, right to use and lease of liability is not there. So what lands up happening is US GAAP, if they have done a right to use and lease liability, we'll end up reversing the entire thing, which becomes a permanent because we do not want to see any traces of lease liability or right of use assets in our balance sheet. So if we post this reversal entry, basically the entry at the end becomes expense account debit and we credit wherever the vendor initially had gone. So that takes care of it. And because of all the entries that we saw in temporary, we have our cost plus entry, which also goes up or down. And then we have got our tax computation, which leads to this true up or true down. So that's how basically this entire sheet works. So now if you see here, there is no reversal account. The reason being we will be carrying it as long as these entries do not form a part of US GAAP or these entries do not are not posted into the SAP system. So till then, this permanent entries will be only carried forwarded but not reversed because this is long-term timing entries, which is called permanent, whereas current year temporary entries are immediately reversed in the very next period or are amortized in the very next period. So basically that is all about this. And then just like we have permanent in the current year, we also could have had permanent before 2021, and all of those entries are still being carried forwarded. And just like that, just like we have posted current year timing entry, which will be reversed in the next year, there are certain timing entry which we had posted in 2020, which will get reversed in 2021, and that's what exactly has happened here. And if you see here, you will not see any amount because this is this, if you remember, this plus these two has to be my opening balance, and we cannot have any amount in our P&L as opening balance, and it has gone and pushed it down to equity. So if you see here, this is a very good way of understanding things. I had 811K of entry or equity which got created, or profit or loss, whichever the signage is, which got created because of all the temporary entries, which I have now reversed in the current year. So which becomes a part of current year profit or loss movements. So this is a very excellent way of looking at things. So you will see that this 1.69 million has to get reversed in the next year, and this reversal is already coming out of this permanent, and this permanent has to be carried forward, and next year my total permanent would be 485 plus 286K. So that's about how the audit pack works. Just let me see if there is anything else that we need to discuss here. Yeah, reconciliations are very straightforward. Uh, as in when we keep posting the entries, we also keep looking whether the reconciliation makes a sense. And after years of experience, we will know, okay, this number looks right, this number doesn't. And on that basis, we keep modifying or keep updating our reconciliations. So I think that's about it. Cost plus again, this number is the total operating expenditure that we have, which is coming from the uh, stat trial balance. And then all of this is discussed in the roll forwards. I'll not explain again and just add on to the minutes. So okay, so that's about it. You can go through the standard audit pack. The description is the link to the audit pack is in the description below. If there is any query, you can always come back to us and we'll be more than happy to help you guys out. So thank you, and I'll see you in the next session.